Okay, so part 5 in our series of videos on topic 7 is analysing the cash budget. So there's no point in preparing a budget unless we do something with it. So we review a completed cash budget, and that enables us or the firm to make decisions about the most efficient use of cash resources. Okay. So for example, does the firm have too much cash or too little cash at any time? If so, what can be done to change this? So I guess an important point to make here is that budgets should be what we call living documents. They shouldn't just be set and left. They should be able to be revised and reviewed from a period of time. So for example, if we do an annual budget, an annual cash budget, it would be really wise to revise it maybe on a quarterly basis. Now some firms will do like a mini cash budget every day. Okay, so if we're dealing with a large amount of cash, we'll look at the cash that we have versus the cash that we need, and we'll work out whether we need to borrow more cash or whether we've got spare cash either on a daily or weekly basis. Okay, so cash budgets are very fluid or living type of documents. Now, if a business spends more than it has in the bank, it goes into what we call a bank overdraft situation. So this is where they have a negative bank balance. Now for some firms, they do sort of fund their business this way, but it is very expensive. The interest expense for a bank overdraft is very costly, and depending on what your firm is or who your firm is, it can be really expensive. The interest rate can be quite high because it's a rate that can be set at the bank's discretion. Okay, so for most firms, they like to keep a positive cash balance, and they will try and avoid the bank overdraft situation. And in order to do that, they can look at their cash budget and see whether are there any items of expense that can be moved to another month, or is there some way of increasing the cash that we have, or is there a purchase that can be delayed? So that type of strategy can be done. One thing that cannot be deferred is tax or dividend payments. Okay, so if we know that we have to pay our GST to the ATO by a certain date, that can't be deferred. Also, dividend payments to owners are usually scheduled at certain times. But things like business extensions, if the firm has asset purchases or it's going to extend its building as an example, that can be delayed depending on the contract with the builder or the contract of purchase of the asset until cash resources are available. Alternatively, we can obtain a long-term loan specifically for the building extensions and then add the interest and repayments into the cash budget. So sometimes a long-term loan can be negotiated as a cheaper rate than bank overdraft interest. Okay, so if it's not possible to delay something like our building extension because we have a commitment or a contract, then we might borrow money in order to facilitate that. There are ways we can improve the cash position. We can, cash receipts can be increased, and we can do that by measures such as improving the collections of cash from debtors, seeking ways to improve sales or fees. We can reduce excessive levels of inventory, arrange external finance. We could ask for extra capital contributions from the owners, or we can sell excess non-current assets, so things that we are not using at present and don't have a need for in the future. We can improve our cash position by reducing cash payments, so we might cut expenses by identifying areas of waste duplication or inefficiency. We might make use of creditors' terms. So if they offer us 90 days to pay our account, then we might use the 90 days so that we can keep the money longer and use it for other things. All firms should try and keep inventory levels to only what's required, because excess inventory ties up cash and often adds to storage and handling costs. And the other way we can reduce payments is by deferring capital expenditure. So that's expenditure on assets, so things that we'll use into the future. Okay, now the planning that we do or control is we achieve this via the budgeting process. So control is achieved by managers comparing actual results with budgets, and this is what we call variance analysis. This comparison is often used for rewarding workers in firms. Okay, so variances can be favourable or unfavourable. So when investigating variables related to a cash budget, variances are favourable, and usually that's denoted by an F, if actual receipts are higher than budget. It's also favourable if actual payments are lower than budget, and it's favourable if the final cash balance is higher than budget. Variances are unfavourable, and this is denoted by a U, if actual receipts are lower than budget, actual payments are higher than budget, and the final cash balance is lower than budget. Okay, so the way that we do this is, we can see in this example, we compare the budget to actual. So looking at the receipts from debtors, the budget was $285,300. The actual was $238,200, so that results in an unfavourable variance. If we look at a favourable one, we budgeted $26,000 for general admin expenses. The actual was $24,500, so that gives us a $1,500 favourable variance. Okay, at the bottom, so this is actually a cash budget format. So we've got our cash receipts, our cash payments. So we compare our total cash receipts, which is our variance, $47,100 unfavourable. Our total cash payments is $50,550 unfavourable. So two unfavourables give us an even larger unfavourable. So our net cash flow here is $97,650 unfavourable. And the balance at the end of the month will be affected by that unfavourable balance. Okay, so we're certainly less than what we projected. If we have a look at a variance analysis for the month of May, so we just compare one column with the other. You might like to go through and do this with your slides, but we just compare the budget to the actual. So cash sales, $3,086, actual $3,300, so a variance of $286, unfavourable. For the accounts receivable, it's a favourable, so the actual is bigger than the budget, so $720, and in total the cash receipts had a favourable variance of $434. We can go through all of our cash payments and do the same thing. So if we add, you can treat unfavourable as a minus, favourable as a positive. Overall, it's a $10,000 favourable variance. Okay, add the two favourables together, we get $444,000. So that's a variance analysis for the month of May. Once the first comparison between actual and budget is made, managers will, first of all, investigate significant variances further. So why are our sales so low compared to budget, as an example? Provided management can potentially change things to ensure improvements in the future. So if the labour cost is greater than expected because of an increase in the labour award, there's nothing that we can do about that. Okay, so we can't change our budget for that. We just have to suck up the unfavourable. But there might be other ways that we can change the budget to ensure improvement in the future. Okay, so that's the end of the part to analyse budgets. So we're going to move on to the next part, which is the purposes and advantages of budgets.